26 a pound Friday, but New York copper fell 1.1% over the course of the week, and London copper was down about 0.8% last week. Aussie dollar pretty steady there against the greenback, 95.86. It did fall 1% against the greenback last week, and rising against the yen there at 93.6 yen. Well, credit markets have come back to life following the recent US fiscal debacle. Let's get some more analysis now. Mark Bayley, credit strategist at Equasia, joining us right now. Mark, happy Monday to you. Thanks for your time. Just firstly, in terms of what we've been seeing in the equity markets, they've just been rising and rising, fresh all-time highs for the S&P 500 yet again on Friday. What's been happening in credit markets?
Yeah, good morning, Bridie. I mean, I guess we've seen a similar impact on credit markets as well. We've seen spreads tighten as well, but as you have alluded to in that introduction, we have seen a significant amount of new issuance globally and also domestically. I mean, if we focus on the domestic side of things, the real key highlight has been the size of some of the lower rated corporates, some of the BBB corporates. On Friday we had Adani Abbott Point price a 500 million issue. The previous week we had Horizon Network, which was formerly QR National, price 525 million. So those are really significantly larger transactions than would have been probably possible 6 months ago, where maybe 300 million would have been struggle. And it kind of shows investors' appetite and demand for non-financial corporates at the lower end of the spectrum, and for maybe longer maturity than they've been previously. Kind of 7 years, 5 to 7 years is definitely the sweet spot at the moment. In terms of that hunt for yield in this interest rate environment as well, it's pushing those investors further down the credit spectrum into those deals. And we've had a slew of BBB issuance this year that we haven't seen previously. So I think it's kind of a new dawn for the Australian corporate bond market, and we've been saying that for a while. I mean, 15 years ago, we're probably still talking about the dawn and the likely emergence of the Australian corporate bond market, but it really does seem to have matured, and a new lease of life has been given. And I guess wholesale bond market on the kind of the private deals, FIG Securities has done 4 or 5 deals in the smaller unrated sector. Last week we saw PMP, the commercial printer. They've done cash converters, Mackay Sugar, Silver Chef, and GA Education, and that's allowed the smaller to medium-sized corporates to come to the domestic bond market, to high net worth individuals, to price those issues even though they're not rated, and provides capital and provides an alternative either for the large companies from offshore bond markets, and also for the smaller issues, kind of freeing up and diversifying some of those dependency on the banks.
Yeah, and I mean, as you said, there has been several false starts, and obviously the focus traditionally has always been on financials issuance, but yeah, as you said, this is really spreading beyond that.
That's right. I mean, the financial sector in the Australian corporate bond market is still the bulk of the issuance out there, and investors are kind of always been starved of non-financial corporate to diversify away that portfolio from the skew that they have towards financial. So any kind of new issuance, and a lot of these issuers have been debutants, have been inaugural issues in the market, and they've been well received by investors. As long as those companies have done a good investor roadshow and helped educate investors and bring them up to speed with the credit, and they've been priced at kind of fair value, then the investors have been buying them. And I think they're still absolutely starved for issuance out of the financial sector, and it will probably encourage new corporate issuers that maybe don't even have a rating at the moment to get a rating and try and tap the domestic market. So the demand clearly there for them to be able to do this now. Yeah, that's right, and I think as I said before, the 2 recent deals over the 500 million deals really does set a big size benchmark for future potential deals for that market. I mean, previously, probably 12 months ago, even longer, maybe 200, 250, 6 months ago, 300. But to get those 2 sizable transactions out in the market, which will hopefully provide significant liquidity as well in secondary trading, and give investors comfort that they can still trade those around their primary positions and their primary allocations. And I think that will really help develop the market, and hopefully we'll kind of see the fruition of the market that everyone's been expecting and demanding, and it has kind of failed to deliver previously. But as I said, fingers crossed for a new dawn.
And just in terms of the returns that you can expect, the yield, I mean, what have you been noticing in terms of the corporate spreads, particularly in light of course, all the debate over tapering and when that might begin?
Yeah, I mean, I guess that all kind of flows into the credit spreads. I mean, if you actually look at the 10-year a graph of the 10-year US Treasury benchmark since kind of June when tapering was likely, and then in September when it hasn't, you've seen a general uptrend in spreads, but actually in yield, in credit spread in iTraxx or in Australia or Europe or in the States, you've actually seen credit spreads actually contract. So it's actually been a credit positive environment, kind of forgetting about what's happening to underlying government bond yields. And I think that probably trend will likely to continue. You're going to have support again from the tapering, which I don't think we'll get any announcement on that later on this week on Thursday at the FOMC. I think you're probably pushing that out to March with Yellen's confirmation likely to be at the start of November, and she will start her new role in the 1st of February. So I think you March at the latest before you start tapering, and that's obviously very positive for risk asset classes, equities, emerging markets, and also credit. So I think you're going to see the spread environment still be fairly positive for the next 3 or 4 months, and I think that will encourage more issuers to come out to the market to test appetite and invest demand, which is certainly there, and they're searching for yield in this low interest rate environment.
And just in terms of the timing as well, I mean, a lot of the issues seem to be sort of between 5 and 7 years. Is that traditional for those kinds of non-financial corporates?
I guess it has been probably more towards the 3 and 5 years. So I guess investor appetite is not only being seen for additional risks going down the rating spectrum from, say, single A down to triple B, and then a couple of deals have been very low rated triple B minus deals. But also in terms of maturity and pushing down that spectrum. We have seen some triple B deals previously that have been 10 years, but generally speaking, the lower the rated the credit, the shorter the maturity. So probably 3 to 5 years has been more normal, but so that 5 to 7 years again is kind of stepping up to the plate. And I think domestic investors, and a lot of these deals have been driven by the domestic investor base. The fund managers local fund managers have been driving these deals in terms of support and the allocation in that primary. I think they're comfortable with that 5 to 7 year maturity as well as the triple B credit ratings.
Mark, it's always great to get your analysis. Thank you so much for joining us.
Thanks, Bridie.
Mark Bayley there from Equasia. Well, US shipping giant UPS is seeing its profit rise sharply on strong demand for domestic and European shipments. The surge